Disclaimer, I am not licensed. You should always check your information before using it. Hey everybody, this is Flip Flop, and today we're going to go through 5 things that a newly investor would ask. Number 1, what is the risk tolerance, and how can I figure out what mine is? That's a good question. Risk tolerance comes down to how much risk you are willing and are able to take on. So it depends on how much the risk that you're willing to take, how much money you're willing to risk, how much time are you willing to risk, how much are you willing to risk is really comes down to your tolerance, your risk tolerance. A good rule of thumb to follow: if you're up at night thinking about the investments that you make, then pretty much I assure you that it's probably a little too much risk right there. If you're staying up at night thinking about these investments, it's something that you shouldn't have to do. So if you're staying up at night thinking about this, then that's too much risk. On the flip side, if you're worried that you're missing potential gains, you might be too conservative. I suggest that you work with a financial advisor to gain a more quantifiable measure of risk you are willing to take based on time, goals, and objectives. So again, it comes down to how much time, how much money, what are you willing to risk to gain? What are you willing to risk to gain? Second one is, what can I expect when I invest into the stock markets? So mainly, what can you expect when you invest into stock markets is there's going to be risk, because all investments carry some degree of risk. And the market is impacted by many forces, like earnings, consumer emotions, political events, and even natural disasters. So you got to keep an eye on the stocks when it goes through it. It determines on if you're a long-term or short-term investor, that the risk is there, and there is potential of you losing your money. For long-term investors who can absorb the risk and ride the ebb and flow of the market, they have a potential of keeping the flow, keeping the money. The third one is, what is the best way to invest in a volatile market? DCA, dollar cost average, is an investment technique which works well in volatile markets by dividing the total sum to be invested into the market into an equal amount. By divvying up the total sums to be invested in the market into equal amounts, investing into the market at regular intervals. Example, so let's say you had $12,000 in your pocket. You would invest $1,000 per month. This strategy reduces the risk, incurring a substantial loss if the market were to crash. Most important point is not to miss the market's gain by trying to predict the best time to invest. It's time in the market, not timing in the market, which is the best way to capitalize in the stock market. Number 4, how can I minimize my risk when I invest? Best way to minimize risk is to make sure you are well diversified. This method is where you invest your portfolio in many different kinds of assets, such as stocks, bonds, and cash assets. Each asset reacts differently to an economic event. Diversification is the way to get high returns with low risk. And finally, number 5, what is the most important rule of investments? And that rule is, guys, don't spend money that you are not willing to lose in the stock markets. If you're not willing to lose that money, if you have to have that money for bills, for anything that you need in life, don't waste it, okay? Use that money on yourself first, and then invest into a well-diversified portfolio, okay? Guys, that is all today. I appreciate the time. I really do. You guys are the reason I'm doing this, to give out information and to help everybody see that there is a way to make money by doing absolutely nothing, by sitting on and enjoying your life like everyone should. All right, work smart, not hard. Okay, guys. So enjoy yourself. Goodbye.